Welcome to the Neighborhood Law Center. I'm your host, Melvin Burruss. And today we have the honor of having Bernard Whitsett. He's a financial well-being coach with New Hill Development Corporation, which has a partnership with Operation Hope. And he's going to tell us today about first-time home buyers, getting your credit together, and how you're going to purchase a home and what type of home you'd be qualified for. Now remember, the prices of residential homes are skyrocketing in the Central Virginia area. And so there's some tips we want you to listen to so you'll be better prepared when you go out to talk to a banker, your mortgage broker, or even your real estate agent, okay? So Bernard, tell the audience a little about yourself to give them a little background of what you're doing and how you can help them out.
Well, thank you, Mel. And first and foremost, thank you for having me today. We appreciate the opportunity to tell you more about the partnership of Operation Hope and New Hill Development Corporation, which is a relatively new nonprofit organization located in the Charlottesville area, and the president and CEO is Yolanda Harrell. We are focused on financial capabilities, economic development, as well as employment opportunities through entrepreneurship and small businesses. As a result, I'm primarily focused on financial well-being as a means to financial capability. And the first and foremost goal is to have people improve their financial capacity. And one has to improve their financial capacity through increasing their credit score. By increasing their credit score, they're provided with various opportunities and options that they would not have if they have a very poor or low credit score.
Okay, that financial capacity now, it's more than just credit score. We're talking about savings account, learning to save, to set aside emergency funds. All that goes into the financial capacity?
Absolutely, because not only are you rated by lenders of money, you are also rated by your bank. So if you are banking with an organization, first and foremost, you want to develop a relationship with that organization. Secondly, you need to have savings, okay? And the reason you need to have savings is that the more you save, the higher your score is within the banking system. They know you have the capacity to do other things such as borrow money for installment loans, which may be an automobile loan, or borrow money for home improvements, which may be considered a personal loan. Or in the final analysis, most people are trying to borrow money to buy a home. Given your statement about what's occurring in the housing market, many people have found that they are being excluded from the opportunity of being a first-time home buyer. So what they need to do in this type of environment is possibly think outside of the box. Many people have etched in their mind this idea that they need to have a single-family home with a 2-car garage and a white picket fence. Such a scenario is a very expensive proposition and scenario in today's current market. So I'm trying to get clients to consider options or alternatives, such as buying a townhome, buying a duplex, buying an attached property, buying a condominium. Because remember, over time, the goal is to build equity. So your first purchase doesn't have to be your dream home. It may be considered your starter home, so that you can start and be in the market as a home buyer in maybe 5 to 7 years from now, you can parlay that equity into a bigger place, a bigger square footage, bigger value home.
Okay. One thing you said was some home buyers today are excluded from first-time home buyer situations. What do you mean by that?
Well, your traditional, conventional home buyer is most likely going to be considered a 20% down person. So if they're buying a house that is $500,000, they're going to need $100,000 in cash as a down payment, all right? But given the fact that through FHA, through Freddie Mac, and through Fannie Mae, they've been able to come out with more creative programs that are allowing people to put down anywhere from 2.5% to 5% of the home value. So what that requires is, of course, less money up front. But you're going to have more income because you're going to be taking on a larger mortgage. And as your mortgage increases, your income has to increase. All right?
Okay. The other question we have to explain to our audience, what do you mean by tax property? You said that was an option that people could purchase as tax property.
So you're saying considering buying properties that are in foreclosure, whether it be due to one's inability to pay, one, the mortgage, which means the bank foreclosed on it, or two, the inability of the current owner to pay the taxes, which means the city or the county foreclosed on the property.
That's correct.
Okay? Mm-hmm. So typically those properties are going to go through some type of bidding process where the property will be sold and people will be bidding on it. So you're going to be competing with other buyers. And generally speaking, cash is going to be king in that environment because they're going to have investors bidding on foreclosures and tax lien properties. And the investors tend to come with cash. So one of the things they may help mitigate that process for someone who's looking to buy a tax lien or foreclosed property is to make sure that they are pre-qualified or pre-approved by a bank to buy a property.
Okay.
Because they'll get a good idea of how much property they can buy, okay? And they can get a letter from the bank saying, this, based upon the current data that we have on this client, we have approved, we have a qualified approval for them to buy a $500,000 house.
Well, isn't that important for all purchases or real estate actions to get a pre-approval?
Very important. In fact, most real estate agents will not take a client out unless they have a pre-approval, pre-qualification letter. Okay. And the reason for that is they don't want to waste their time. Mm-hmm. You know, time is money to a real estate agent. They only get paid if they can sell you a house. So they're not going to take you around to look at 50 homes going all over central Virginia and the surrounding area to show you homes and you can't afford a home. Okay. All right. So 9 times out of 10, a real estate agent is going to ask you that very question. That's going to be their first question. Are you pre-qualified? Are you pre-approved to buy a home? How much home can you buy? Because it's no need for you to be looking at $1 million homes if you can't afford $1 million home. So they want to get an idea of your price range so they can start a research and look at the MLS, that's the multiple listing service, so that they can figure out what areas you want to live in. Because not everybody wants to live in certain areas. Some people want to live south of the city. Some people want to live north, east, west of the city. How far do you want to live? Do you want to live 30 minutes out? Do you want to live 90 minutes out? That all is a factor in determining the pricing of homes.
Okay, so now let's go back to your classes. what you're teaching people. I understand you hold classes. So, but what are some of the common mistakes people make when first starting out, as you're saying, financially, to purchase a home?
Lack of knowledge.
Okay.
They don't know the process.
Okay.
Okay? And they go and buy something. I see this time and time again, whether it's a home or whether it's a car. Because remember, when you are buying a home, your credit really has to be in order. Okay?
So how do you prepare these folks to avoid these mistakes?
Well, they have to be willing to do the work. You've always heard the cliche, you can bring a horse to the water trough, but you can't make it drink. Mm-hmm. I can provide them the knowledge and the expertise and provide them the advice that they need to do the job. But in the final analysis, they have to be willing to trust what I say is true and fact, and that they have to put that to work, okay? So one thing I have, a very common practice, is that someone will go and buy a car. And they'll come back and say, I got a car. And I said, okay, should I congratulate you on buying a car? And they say, well, why do you ask that question? I said, well, how did you buy the car? They said, I borrowed money. I said, okay, what is your interest rate that you're paying on buying that car? And 9 times out of 10, many of the people have no clue what the interest rate is that they're paying on a car.
Hold that thought for a minute. Welcome to the Neighborhood Law Center. I'm your host, Melvin Burruss. And today we're talking about purchasing real estate or purchasing your personal residence. We have with us an expert, Bernard Whitsett, and he's been explaining to us some of the issues that buyers find or buyers are involved with when they first purchase a home. So he's going to take us through that process. So what I'm going to ask him, one of the questions we were asking, how do we avoid those mistakes? And explain to us why it matters to have good credit.
It's very important to have good credit because a bank, a lender, is trying to mitigate their risk. They don't want to go through the process of taking you through underwriting, knowing that 3 months from now, you're going to end up in foreclosure. Banks are not in the business of owning homes. They're in the business of lending money. They don't want to own homes. They don't want to have non-performing assets on their books, okay? So they don't want to own your home. They want to lend you money, and they want you to pay the money back, okay? But if all fails, they will take your home, okay? And then they will sell it. And they will sell it so they can get rid of that non-performing asset, all right? So the goal is to make sure that your credit is impeccable, because when you have impeccable credit, you have options. You have multiple lenders that are willing to lend you money, and they're going to compete for you. So as a result of their competition, that's going to reduce your cost of borrowing, because they're going to give you a lower rate because you have such good credit. And they realize that if I don't take this client, the bank down the street is going to take this client. All right?
Okay, let's go on back to you were talking about the automobile and the high interest rate.
Yes.
And the high interest rate was because of a low credit score, I assume.
Yes.
So it's directly related. Interest rates are directly related to the credit score.
Credit score or lack thereof. Mm-hmm. So in other words, there are people that don't have a credit score. And since they don't have a credit score, it's a guessing game for anyone that wants to lend them money. They have no knowledge, no history of what your spending habits are, or what your borrowing habits are, or what your ability to pay back things are. So they're basically saying, okay, what are we willing to risk in order to lend this money so this person can get this car? I have some clients that have car rates of 36%. okay? And no one should be buying a car with an interest rate of 36%. Because if you are borrowing money at 36%, we know that that money has been paid back twice within 2 years at 36%. So you've paid them not only what you borrowed, but you also paid them twice that amount.
Okay. So let's talk about the range of good credit.
Okay.
What is the range of good credit? And how's the best way to build that good credit?
Okay. The range of good credit.
Based on the banks that you've been have a
Okay.
relationship with.
A excellent credit score is going to be 750 or above. Okay? A good credit score is going to be 680 to 749. That's a very good credit score. Okay? 640 to 679 is a good credit score. All right? But you must remember, as your credit score goes up, your borrowing costs go down.
Borrowing costs being the interest rate.
Interest rate, other fees that banks may charge in order to provide you the loan. All right? So not only are they charging you a fee for borrowing the money, they're going to charge you fees for running your credit. Okay? So every time they run your credit, it may be $35, $40. So if you're uncertain credit, they're not going to run your credit once. They're going to run your credit on multiple occasions. So that's a cost that you're going to incur because they're going to charge you that for running your credit. All right?
Okay.
So keep that in mind. So in the current environment, you can buy a house with a credit score of 640. I don't recommend that people do it. I recommend that they go and buy a house when the sweet spot is 750, okay? That's where you're going to have lenders competing over you for the business. And that's really the goal, okay? Not to say, can you borrow the money, but the question then becomes, who will you borrow the money from?
Okay. So we have a relationship with higher debt, lower scores usually, unless your income is high, as you referred to before. So what is some of the best ways to tackle reducing my debt and making myself look good to the banks?
The first thing you have to do is you have to really employ a tight monthly budget.
Budgeting.
Budgeting. Most people don't have a black and white written down budget, okay? And they need that. Not to say that sometime in the future they can get away from the black and white concrete budgeting because it's all up here in their mind and they'll know it. But it takes years of practice to be able to say, this is what my budget is, and just be able to rattle off, this is what I'm paying every month, okay? So you have to have a tight budget. Secondly, you have to save money, okay?
What is the normal rate or average percentage that you should be saving every month?
Ideally, you should be saving 20% of your income every single month, okay? And that's 20% so that you will be able to retire eventually at some point and that you will not have to work, but you'll have the option of working. That you can say, okay, I want to leave this job and I can leave and know that I can continue to live at my current living expense level and not take a hit, all right? So if you save 20%, not only are you saving for tomorrow, you're saving for tomorrow and you're saving for 30 years from now or 20 years from now.
So you're saying my 20% into my retirement account, I can use that. There's rules and everything that I can take some of that money out to purchase a home.
Possibly. But I'm saying this, collectively, your retirement, your intermediate savings and your emergency saving should equate to 20% of your paycheck
Okay.
every month, okay?
Total savings.
Total savings.
For emergency
because
fund.
you should have an emergency fund. That should be the first fund you should have, okay? Do you realize that 70% of the people in the U.S. do not have $400 in a bank account in order to pay an unexpected expense? Okay? If you are driving down the road and you hit a pothole and you flatten your tire and you bend your rim, it's going to cost you over $400 to get that repaired, okay? And it's not going to be a claim that is going to be covered by your insurance company. Most people are going to have a deductible somewhere between $500 and $1,000. So you need to have an emergency fund, and I always recommend that people have an emergency fund somewhere between $1,000 and $2,000.
Okay, you don't go by the amount of expenses that you may have, so you can cover that for 3 to 6 months?
Emergency fund. Emergency fund is something extraordinarily happening at a moment's notice, and you have to address it immediately. That's an emergency. You're talking about frictional job change. You're talking about an intermediate savings account. Okay.
Okay, so you got your
an
immediate.
intermediate savings account. The bottom line is this: the rule of thumb is, for every $10,000 that you make, you should have 1 month of savings. So if you make $100,000, okay, you should have 10 months of unemployment savings. All right? So almost a full year available to you if for some reason you're laid off and you need to find employment again.
Okay, so
The more money you make, the harder it is to find a job of a similar income level, okay? If you're making minimum wage, you can go from this job to that job to here, okay? Everyone wants minimum wage employees, right?
okay, so we're talking about our 20% savings account to cover our emergency fund, our immediate needs, savings, as well as our retirement.
Yes.
Okay, so we go from there. Now, what are the top 3 tips for people regarding their finances?
First tip is you don't know it all. And realize it, okay? And don't depend on a relative to tell it to you. You need to go out and get assistance. That's the wonderful thing about the partnership between New Hill Development Corporation and Operation Hope is that my services are at no cost. They are free, all right? So I can work as a financial counselor to people in the area, assisting them in meeting their goals and objectives. That's the number one thing. The number 2 thing is you must save, okay? Which means that if you're saving, you're most likely budgeting and you're watching your budget. The number 1 item that I tend to find people have no clue on and is the major challenge is they really don't know where their money goes month to month. If someone were to give you $100 cash on Monday and then saw you the following Monday and asked you, Mr. Burruss, do you still have $100? And you said, no, I spent the $100. And they said, Mr. Burruss, can you tell me where you spent the $100? 9 times out of 10, most people cannot tell you where that $100 went to. They can't. They don't remember what they purchased to get that done.
Okay, those are the 3 tips. Sounds pretty good to me. My audience, you should take this and use these tips to put yourself in a position not only to purchase a home, because you may have a home, but to solidify your finances moving forward. Now, the area that you cover is Central Virginia, or is it different areas in Virginia?
Well, due to the pandemic, the majority of my program has been virtual. So as a result of the virtual nature, I have clients in California, Florida, Alabama, Mississippi, New York City, Michigan, Chicago, just to name a few. However, we will be going back to in-person workshops. And again, the goal and objective of our program is to serve Charlottesville and surrounding area. So we're talking about basically Charlottesville, Albemarle, Louisa, Fluvanna,
Central Virginia.
Central Virginia, Orange, North Garden.
We're running out. We're running out of time. It's been very interesting. Just tell our audience how they can get in touch with you and what you want to leave with them.
So the first thing they should do is go on the New Hill Development Corp website. That's newhilldev.org. Go on the website and go to Financial Counselor. They can get my telephone number, my email address, and they can contact me and set up an appointment to meet with me.
Okay. All right. Thank you for watching. Thank you for being here, Bernard.
Thank you for having me.
You taught my audience quite a bit about finances. This is the Neighborhood Law Center. You can see us. If you don't see us on the TV, on cable 13, go to the website, neighborhoodlawcenter.com, or you can go to YouTube, and you can see us on, just type in Neighborhood Law Center, and we'll pop up. And we look forward to seeing you next week. Peace and God bless. Thank you again, Bernard.
Thank you.